Hector, do you want me to play both of them? Is there one you prefer over the other?
They're pretty short, both of them, so I think we
Okay.
could play both of them. It's fine.
Okay.
Yeah.
All right. You guys have to give me 1 second. I just want to make sure I'm sharing my sound. Um, so the first one I'm going to show you is a YouTube video, and and it's kind of everybody's. I'm sorry. Good morning, everybody. It's like everybody's favorite thing to say when they're talking about index universal life, and it's to be your own bank. So if you ever hear anyone asking you, or saying stuff like, "Yeah, because I want one of those things where I can be my own bank. I like to be my own bank." This is a way of marketing an index universal life policy. So I'm going to share a video, a short with you on how what some of the agents say in order to convince people to now get into this type of product. All right.
5 steps to becoming your own bank. Number one, open an index universal life policy. Make sure you pick an agent that knows what they're doing. They need to structure it properly, otherwise, it will not work. Number two, fund the policy with either an annual contribution or a monthly contribution. Number three, allow your money to compound while being protected from stock market loss. Number four, next time you have a purchase such as a home, a car, or an investment, borrow from your insurance policy so you can access the money tax-free without interrupting the compound interest on your account. Number five, keep your policy for life so that when you pass away, not only will your money go to your beneficiary, but there will also be an additional death benefit that goes to your family, and all of it transfers tax-free.
All right. So you guys heard
Have
that,
you ever
right?
felt like you were trapped? Like it's a
So you guys heard that, right? So they're telling people to, fund these policies for life, and, they have to make sure they structure them properly. So just kind of take note, because when people come to you, these are some of the things that they've heard. I'm going to share one other one. This one's actually a TikTok video, and, a lot of people get their financial advice from TikTok. And this is also someone telling their viewers how to create their own bank. And this one's pretty short as well. So Hector's going to talk about how you dispel some of these myths, during the training today. So just take note of what they are saying. All right, my sound is shared. And let's see if I can.
types of people and three types of
Uh, I don't know how to restart.
taxes. You want to go from tax now to tax.
Mm, I don't. All right, here we go. Let me try it again.
If you don't have these four things, you don't have anything, folks. You got to have growth, safety, tax advantage, protection. What does the banks give us in America on average? -1%. You could get up to 15% compounding. Also, you have safety, which means the monies that you have here, guaranteed no loss, plus tax advantage. You know, there's three types of people and three types of taxes. You want to go from tax now to tax free, folks, and everybody needs protection.
You got her. And so all of these are
If you don't
listed
have these four
as,
things, you don't have any.
be your own bank, right? So all of these are a way of marketing index universal life and cash value policies. And we have to know what they are saying so that when people come to us with these things, we actually know how to dispel those myths. So I'm going to turn it over to the amazing Hector Lazo, who's going to lead our training today.
Awesome job, Shonda. So yeah, guys, I think we have to get really good at becoming professionals at what we do. Because these guys out there that market these kind of policies are really great marketers. And one thing that you have to realize is that they're not held to the same standard that we're held to because we are we're much more highly regulated than they are because these policies are sold. You just need a life insurance license. You don't need an investment license. And once you start learning a little bit more about our industry, you'll quickly learn that once you're investment license, it's like a whole new level of regulation, a whole new standard of Something called, becoming a fiduciary. If you guys have heard of that, fiduciary is you have to have the client's best interest at heart. So we are held to a higher standard. So I'm gonna share. I know there's like varying levels of people with different knowledge levels. So we're gonna cover like from the basics to some of the more detailed stuff, and then we're gonna show you like a policy, uh, kind of putting all this stuff together. So I'm gonna go ahead and share my screen. Can you guys see me? I'm seeing Shonda on my screen. Yeah. Okay.
We can see
We
you.
on we see you and
Okay.
We don't
everything.
see what you're sharing if you're sharing anything.
Yeah, about to do that right now. Okay, so let's now you should be able to see it here in about a second or two. You guys see that?
Yeah.
Okay, awesome. So Universal Life, you see that book? That's about what they look like, right? They're like a lot of these policies are like thick like books. Okay, so a lot of people they don't really take the time to read through the whole thing. I've seen some of these policies that are like 150 pages, no lie. So if you guys have ever heard of Warren Buffett, one of the advice that he gives is he never invests in something that he doesn't understand. He always keeps it very simple. When it comes to these kind of policies, they're so complex, guys, that it's very difficult to understand. Even if you're licensed in the industry, even if you have an investment license, even have an insurance license, these policies, you have to know that they're written by lawyers. Okay. So they have all this technical jargon and language that makes it really, could make it very difficult to follow. Um, so let's start with the basics. What is a universal life insurance policy? So it's a type of life insurance policy with an attached savings account. Okay, so you have insurance and you have savings all combined in one package. Okay, and this investment portion is invested in a separate account called an index. Okay, so the the insurance part is works something like an annually renewable term insurance. So basically what happens is as you get older, you go from 25 to 35 to 45 to 55. The cost of your insurance goes up every year because you're getting older, but the benefit amount of the insurance typically stays the same. Okay, think about anything in your life, right? How many people like paying more every year for the same product? You guys like paying more? I mean, would you be happy with paying more for your mortgage every single year or more for your car payments every single year? Right? If you had a choice of having a fixed payment versus an annually increasing payment on the same service, which would most people pick? I think most people would pick
Fixed.
a fixed. So the portion that's the insurance part of this policy, it increases yearly, okay, and it gets more expensive. A lot of times people don't know, and I'm gonna share with you why people don't realize that that their payment is going up. That's kind of all built in. So what is an index? Okay, because you have the insurance portion, which we just went over. It goes up every year. And then the separate investment is invested in something that is kind of like it's a type of account that attempts to mirror actual investments like the S&P 500, but it's not directly invested in equities or the stock market. Okay. These guys make it sound like we're putting your money in and we're investing it so it can compound. You saw the guy, right? Compounding 15%, which sounds amazing, right? And then they throw in
No
these
risk.
guarantees.
15% with no risk, Hector. How about
With
that?
no risk, with no risk. Okay, we're gonna get we're gonna dispel some of these myths, right? And why it's impossible for these policies to return those kind of promises that they market. So now, what is an equity? Because they they invest this, right? And when I say equities, think of ownership. So when you buy a share of Walmart, you now own a small part of the company. So if Walmart has a good quarter, then they share those profits with you, the owner, in the form of a dividend. Okay. And this is not the case in the separate account of an index universal life policy because they're investing in indexes, not stocks, not equities. Okay, we're gonna come back to why this is important because up till recently, whenever I looked at my investment statements and whenever I looked at clients' investment statements, I would look at like the returns, right? And it gives you a breakdown. And
Hmm.
a big portion of the returns, Prince, was like, oh, wow, like
Absolutely.
the
Yep. Dividends.
dividends are
Yeah.
like a big part of this return at the
Yeah.
end,
Yeah.
even though the market goes up and down. But if you're not in it and you're not familiar with it, you don't even realize it until
Yeah.
you're looking at this stuff. Okay.
Yeah.
So I'm going to come back to dividends and why it's important. Um, now, why does it matter that they are not investing in equities? It says historically, dividends have played a substantial role in stock market returns,
Mhm.
and over the 1930 to 2024 period, dividend payments and reinvestment contributed to 40% of annualized total returns of the S&P 500.
Yeah.
So if you guys don't know about the S&P 500, it's like a collection of the 500 biggest companies in the stock market, right? And then that's kind of like a barometer for how the economy is doing as a whole. Okay. Now, if you don't include reinvested dividends in the S&P 500, returns from 1928 to 2022, the average annualized return was only 5.8%
There you go.
versus
It's a big
9.9% when you factor in
dividends.
dividends.
That's a big deal, man.
Almost double.
Yeah.
That's a big deal, man.
No, Deepak talks a lot about the rule of 72, right? And all that stuff. And you see the difference that it makes if you invest in a 3% versus a 6% versus a 12%. So even like a percentage point or two or three can make a substantial difference when it comes to your returns. Okay. Now, a little bit more, and I know I'm getting into the weeds when it comes to this dividend stuff, but I found it fascinating because whenever
This
you,
is good.
yeah. Okay. So a lot of these companies they pitch their returns, right? They have these hypotheticals of, if you invest with me, uh, then these are the kind of returns that you can expect. But here's the thing. The returns that they use are something called price returns, okay, which are different than the kind of hypotheticals and historical returns that we use. Okay, and you can see right there the deception is in IUL policies compare their performance to the S&P without dividends, and it makes their hypothetical look a lot better. Now, why can they not use the dividends, and why would it be disadvantage for them to use dividends?
Because they don't give them.
They don't give them, and they don't. A lot of them are not securities licensed, right?
Hmm.
So this is like a whole other level of investment talk, right? So take a look at this. If you take a look at S&P returns from 2001 to 2018, okay, um, the return that bottom line that you see right there is it says $100,000 invested in 2001 uh, with dividends would be 371,000. Okay. Now, if you remember, a big portion of the returns when you
Mhm.
invest come from dividends, but these guys use these projections without dividends. So without dividends, it's $290,000. So if you're investing in this type of investment, because they sell it as an investment, you're not participating in one of the aspects of an investment that would lead to you gaining a lot more returns.
Yep. Heck,
Okay.
the argument would be that there's no downturn.
Yes, we'll get to that. We'll get to that. Yeah, yeah. That's a big thing that they like to harp on, right? But that's an $81,000 difference,
Correct.
right? Remember, the whole goal when we sit down with a client is we want to make sure that they become financially independent.
Mhm.
Okay. So you have to have everything working in your favor to make sure you hit those targets. Even like a percentage point or two, you include dividends, you include all these things in there. That makes a compounding difference at the end of the day. Okay. Um, okay, so but isn't it risky, Prince, to invest in the market? They'll say, right?
Yeah.
You don't want to risk it, do you? Like I know a guy that had a 401k at my job, and then during the pandemic, his account went from 100,000 to 60,000. He lost $40,000 and he took it out.
Bad
Well,
idea.
then you did lose money, right? But it's kind of like real estate. Like if you're investing in
Absolutely.
real estate, would you ever if you could help it, would you ever buy a house for 300,000, and then the market went down, and now your $300,000 house is worth 200,000, and then you sell it? Is that when you want to sell it?
Okay.
You don't want to do that. You want to wait till the market comes back up and then you sell it. Okay. So in 86 years, okay, you took a look at the market returns, and this is from 1937 to 2022. Um, there's been 14 up years. We're under 10%. And the reason we bring that up is because a lot of these policies, not only do they not participate in dividends, okay, but a lot of them also have what's called caps.
Mm-hmm.
But what a cap is let's say if I have a 10% cap on my investment account and the market does 30%, okay, I'm only going to be credited up until that cap
Mm-hmm.
of 10%. So what happens between 10 and 30? That 20%, guess who gets that money?
The company.
The company gets that money.
Mm-hmm.
Okay. So there's been 14 up years that were under 10%. Okay. So you'd be fine there in those years. But there's been 51 years where the returns of the market have been over
Yeah.
10%. And when the market is up, the average up is 19.7%. So those 51 years, right, have if you're invested in something that caps you off, you're losing out on like
Yeah.
tons and tons of returns.
Yeah.
And this is causing IUL clients to miss out on massive returns. And the average return has been 10.4% over the past 86 years. Okay. So we can actually point to statistics, right? We can actually point to, hey, let's go back to 1937 to 2022. Let's see what the average returns have been. 10.4%. You know, when they say it's like going to the casino and gambling your money away, there have been 24% of the time the market has given negative returns, and 76% has given positive returns. The average positive has been almost 20%. So what they try to do is they try to use all these scare tactics, and they always like to use like the from 2001 to 2010, which is like the long decade, right? To scare
Yeah.
people into saying you don't want to invest in the market, it's too risky.
Yeah.
But if you know a little bit about history and you know about actual historical returns, you know that, you know, historically, your best bet is to be invested in the market and being invested in equities that participate in dividends. Okay, so I know I got like way into the weeds on that kind of stuff, right? But I wanted to in this right here you see that this company has a cap of 8.75%. Okay, and it has a floor of 1%, which means this is what you said, Prince. Like if the market goes down -20, then you don't lose
Mm-hmm.
money. This is the big thing that they kind
Yeah.
of hang their head on. Okay. Now let's take a look at index funds versus an IUL. Okay, I'm gonna read this. Okay, but the chart that you're seeing right now, because a lot of these guys they sell this as an investment. Okay. And
Yep.
that's the big thing. An investment, investment, investment. Insurance is kind of like an afterthought when it comes to how they sell these policies.
Yeah.
So the chart below shows $500 a month invested in an S&P 500 index fund versus a $500 premium payment towards an index universal life policy with a 0% floor, meaning you can't lose any money on the index universal life policy, and a 12% cap, and zero fees, which none of those policies, by the way, have zero fees. They have very high fees. Okay. So even if we give them the benefit of the doubt, look at what it says. In this chart, I'm giving the IULs way too much credit. I'm assuming they have zero commission fees, zero cost of insurance, 100% participation rate, zero annual fees, etc. I suspect if we look at the typical policy, the final value of the IUL would be less than half of what's shown here, right? Because they have such high fees. If you're not familiar with IULs, it's an insurance product that's often sold to unsuspecting young investors
Yep.
as an investment by insurance salesmen using the title financial advisor.
Hmm.
The insurance salesman will tout all sorts of fantastic benefits like risk-free growth. IULs lose value to fees for many years before they even break even. And I'm going to show you that in a second.
Yep.
Tax-free inheritance, which you saw the one of those to the lady, right? She was talking about passing that along to your kids. Your first $1 million you pass on is tax-free anyways, generally speaking. I think that's still the case. And unlimited banking, okay, where you can borrow your own money, um, and it's et cetera and so on, right? So becoming your own bank, if you've ever seen that on social media. IULs work like this. You pay a premium, some of which goes towards the cost of insurance, which we talked about, and more of which is taken in fees. What's left is added to a cash value associated with the policy. So you have insurance plus savings minus the fees. And each year, that cash value will grow off of a stock market index. Not the stock market, but the stock market index, like the S&P 500. If the S&P goes down by, let's say, -6%, like it did in 2018, the IUL cash value is safe with a 0% floor. Awesome, right? So I didn't lose any money in my IUL last year, Shonda, even though the market was down 6%, right? That's good. What's wrong with that? If the S&P goes up, the cash value increases by that percentage with a cap, like 12%, like we discussed. For example, last year the S&P 500 was up 16%. This is a couple years old. But the IUL's growth was capped at 12. Okay, so you're missing out on that 4%, right? On those up years. That doesn't sound too bad. 0% floor with 12% potential? Why not? Well, a couple things. First, these IULs ignore the existence of, say it with me,
Dividends.
dividends, right? They look at just the change in the share price of the S&P. Remember, I showed you that chart with
hmm
dividends plus no dividend returns? So they're just looking at that. Where am I? There we go. Okay. Second, this 0%, 12% game is basically a parlor trick to make it sound like you always win, but you don't. In the last 40 years, the S&P 500 was up 31 years. 21 of those were greater than 12%, averaging almost 22%.
Wow.
Okay. It turns out missing on huge growth hurts you way more than the
Oh,
0% downside helps.
absolutely. Absolutely.
I would never purchase any sort of permanent life insurance. If you need life insurance, buy term and invest the rest. And this is an investment. This guy Jeremy, he's an investment
Advisor.
advisor. He, he
Yeah.
he he like manages money. So if you take a look at the red line with the green line, like you putting $500 in both of those, right? You'd end up with about 1.4 being generous to them versus almost $4 million if you invested in S&P. Okay.
Have a,
How many people can give up $1.8 million returns when they get to the retirement? Not a
Mm.
lot of people. A lot of people, when we sit down with them and we run their financial independence number, they're not on track, right? They cannot afford
Yeah.
Two
to
and a
give
half
up these
million
returns.
bucks.
Does that make sense?
Yeah.
yeah.
You're going to
Hector,
say
They
I've
don't have to give up any money.
yeah.
something?
Hector, I've never ran a hypo comparing what the returns you see in the IUL to a regular investment, and it ever beat the regular investment. I've never ran one.
Yeah,
It's impossible.
it's impossible actually for it. And I'll show you here in a second. All right. So I know I got into the weeds, right? But I think it's important for you to understand the components, like the investment components, and why it doesn't make sense for you as a client. Now let's bring it all together, okay? Let me see. Wait a minute. I completely did not share something that I wanted to share with you guys. Here it is. I thought it was blocked out. Okay. So this is one of my favorite slides, okay? This slide basically gives you like a visual representation of how these policies work. Okay. So remember, a lot of these guys they sell this as an investment. So imagine you're investing money for the future and you're putting money into this account. Okay. That's why they're so expensive and you can't afford to make these mistakes. Before the money that you're investing hits your cash value account, your investment, it gets there's these holes, okay, in that bucket. So there's a cost of insurance, there's administrative fees, and there's premium charges. We know from the beginning, we said that the insurance part of the universal life policy, it works like an annually renewable term insurance, which means that the price, what happens to the price every year as you get older?
Goes up.
It
Goes
goes
up.
up, right? So let's say that I'm putting $100 into this investment. Okay, well, before my $100 hits my investment, I got to take out $40 because I have a life insurance in there as well, right? So now we're left with 60. Okay, but from this 60, there's all these fees that I have to subtract out, right? So we take out $14 from the 60. So from every $100 that I'm investing into this investment, 46 is going towards the actual investment account when you take off the insurance costs and the fees. Okay. Let's fast forward 8 to 10 years down the road. I'm older now. Okay. I'm still sending this same $100 payment, but now the cost of my insurance went from 40 to 80. Now, I have not realized this, Gordon, because I'm sending the same $100 that I was sending 8 to 10 years ago, right? To me,
Yeah.
I'm still paying the same amount of money for insurance as I was back then. But now, out of the $100 that I'm putting in this account, 80 is taken from the insurance cost. Now, only 20 is left over for the investment, but we have to subtract out the fees, of course. So now that only leaves $6 for the actual investment. Okay. Fast forward a little bit more. Okay. Now all of a sudden I'm 65, 70 years old. I'm still sending $100. So I'm still like, nah, Shana, like I've always paid $100 and always will pay $100. And my agent told me that my cost will never go up. All right. And then you have a little bit of a surprise because you haven't realized this, but now the $100 that you're sending is not enough to cover the insurance cost. And now that's 160 instead of 100. So now you're short by $60, but then you also got to take out the fees. So now instead of money going into your account, now we have money coming out of your account.
Right.
Okay, how's that?
Not good.
It says take a guess as to where the insurance company takes the $74 from.
That cash value.
Yeah, that's right. It's taking it right from the cash value. Okay. So we're going to show you an example of actual policies where this has happened, right? And there's like even news reports that have covered this kind of stuff. But you know, if you learned that you own something like this, you had an investment that worked like that with such high fees, right? How would you feel knowing that
I don't want it.
you don't want it, right? This is like one of the only products, Gordon, where as soon as you walk in the door, you're losing money
Yeah.
because of how high, how ridiculously high these fees are. Okay, people are being feed to death. And they have things called surrender values, right? So for a lot of these policies, like you put money and you put money and you put money, you're like 5 years in, you put all this money. And if you want to cancel the thing, then the company says, well, Shonda, you have $10,000 in the account, but if you cancel it, we're only going to give you 5,000 or 4,000 of the 10,000
Yep.
because you have something called a surrender fee. Well, what's
Yep.
the surrender fee? Well, like what that agent that you like so much that you referred everybody to,
Yep.
we paid him a very high commission. Okay, and if you cancel it, we gotta collect this from somewhere.
Yep.
Okay, so that agent you like, yeah, that's coming out of your pocket. You're paying the agent. We're not gonna pay the agent. You're paying it from the money you put in. How's that sound?
Crazy.
How you liking your agent? You like him enough to give him $5,000 when you
Never.
when you find out
Nope.
that it works like this?
Nope. Mm-mm.
All right, let's see. So I thought this was like earlier
Enough
on
to
in the
make you
thing.
strangle somebody.
Mhm.
Yeah, when you find out
Yeah.
this stuff. Okay, like give me 1 second. Let me make sure that the order is right on this stuff. Any questions so far?
How is it legal for them to sell this stuff?
Mm.
Um, it's politics, man. Politics is a dirty game, right? Like, and it happens um, in business because a lot of these companies, what they'll do is they'll finance politicians' campaigns, right? And so they'll pass laws to make it, favor the
Favorable.
people.
Yep.
They're like in their pocket, basically. Okay.
Garbage.
Now keep in mind, okay, that IUL policies are sold primarily as
Investments.
investments and living benefits and
Mhm.
tax advantages. Um, the life insurance part is almost kind of like an afterthought. And how are we different than people that peddle these policies? Remember that they sell features and benefits versus our job is to actually create a financial plan for them. What do I mean by that? Well, going back to the basics, right? Either I'm going to die early, so if I die early, I need to make sure my family's well taken care of. So there's a 10 times rule. So if I make 50,000 a year, they need $500,000 in insurance. Okay. And I might make it to retirement, which is the 25 times rule. This is how much. So the problem with investing in one of these policies is if I want to get the right kind of insurance and the right amount of insurance in a universal life policy, the costs of this thing will be unaffordable. So if I want to get $500,000 of term insurance, right, like a 30-year-old, $500,000 of term insurance, and they're healthy, it might be somewhere in the vicinity of like $65, maybe like $70, if that, maybe not even that, right? So $500,000, you'll invest $60 a month and invest the rest. Versus an IUL, you're probably going to be investing like 700 and I mean not 700, but maybe like I don't know, like $500 at least. Easy. 500 or more, right?
Yeah.
Okay, so what I want to do is I don't know if you have it up, Matt. If not, we didn't like
You talking about this policy?
yeah, we didn't coordinate well, but I have another one. But
I can go through one if you want to. I'm ready.
yeah, let's bring it up, and I wanna look at some of the points that we
We
covered
talked
on
about yesterday.
in an actual
It was a
policy.
good one.
Yep. Can you see my screen?
We can see the screen. Yeah, okay. All right,
So
so this is someone that you sat with recently.
the Jennifer, she's on right now.
Oh, Jennifer, how are you, Jennifer?
She decided when we went through this, she decided she got licensed with Globe Life. They sold her this policy, and she didn't feel very trained, or she bought this as an investment. Okay, she Jennifer didn't need insurance. She already had an insurance policy. She wanted an investment. They sold her this as an investment. Did I explain that okay, Jennifer? Is that true?
Yeah, that's true.
So she has this investment. Okay, so there's a couple of things. First off, this says, so it says, I'm going to read through this part right. Okay, interest rates, dividends, or values that set forth in the illustration are not guaranteed, except for those items clearly labeled as guaranteed. So we're going to look through this, and they're going to talk about guaranteed and non-guaranteed. But this is telling us that the only the guaranteed matters. Only the guaranteed is guaranteed, right? Says index universal life insurance is not a security in big capital letters. The index and universal life insurance policies are not an investment in the stock market or in the indexes. Now this is terrible right here, this next part. There's no guarantee that any excess index interest will be credited above the guaranteed minimum interest rate for the index account. Additionally, there's no guarantee that the company will declare an interest rate greater than the guaranteed minimum interest rate for the basic interest account. Now, I'm not a lawyer, but to me, what this says is that they don't have to give you anything above what they say the minimum is if they don't want to.
Right.
I'm just, that's what I feel like it says, right?
And the
They
question would be,
decide every year what they want to do, credit to it, and they don't have to credit anything.
Yeah,
So
if
it's even
they don't have
necessarily
to,
based on the index. It's going to, they
right?
look at the index and then they decide, oh, the
They don't want
index,
to. Even if
even
the
if
index
it,
does good, this covers it.
exactly,
The
they can
index can do
decide to do
great.
that.
The index can do great, and they can say, well, we're not going to do it because X, Y, and Z, because here it is on the reason on the first page. We don't have to do it if we don't want to. That's crazy to me, okay? This is like
Matt, can I say something too?
Yeah.
Because I know it might be kind of confusing. I'm a teacher. So anyway, in here, it does say that it does mention the word dividends, right? It says
yeah.
interest rates, dividends, and so if you scroll back up, well, yeah. So anyway, so the challenge is some people are saying, Hector just spent all this time talking about how they don't have dividends, and now we're looking at a policy and then it says something about dividends. I think it's important to remember, go back to your, your class days, that in the insurance world, right, dividends are a return of excess premiums.
That's right.
They're a return of excess or unused premiums.
Mm.
So excess pretty much means you overpaid
Yep.
for your insurance. Okay. So in insurance, when someone's giving you a dividend, it's because you overpaid for the insurance policy up front. You front loaded it, you paid too much. It's kind of like when you pay taxes and you get a return, right? You
Mhm.
paid too much taxes, and a tax return is they're giving you your money back.
You
Hmm.
Well,
got a
in life
dividend.
insurance, you paid too much money for your life insurance, and a dividend is that they're giving it back. So a dividend in investments and a dividend in the insurance world are two completely different things, just for clarification.
That's huge.
Thank
Good
you,
That,
Shonda.
point.
that's
Good
great.
point.
Thank you.
It took me a while to understand that, like for a long time,
That's
right?
huge. That's a
So
huge
it's
point, right?
like it's already you're like even though like we talked about dividends, it's like oh wait, like Shonda said, like it says dividends, but if you don't know the difference, you could be
You don't
taking
know what
advantage.
that means.
Yeah.
And that's a perfect point. Watch this. So you said don't invest in something you don't understand. So this is about to have 9 pages of definitions, okay? 1 page of definitions, 2 pages. Here's an important one. Your illustrated monthly no lapse premium is 1303.80. The minimum monthly no lapse premium is the minimum premium necessary to avoid lapse in the policy. What does lapse mean, y'all?
Cancel.
I'll have
It,
It's
coverage.
canceled. It's terminated.
Good. So in order to avoid lapse, the no lapse period, regardless of the policy value, the premium will be calculated for each policy issued. Policy and rider changes will alter the minimum monthly no lapse premium under certain circumstances. Extra premiums may be required to prevent lapse.
Yeah.
Her premium is $275. Is her policy going to lapse?
Yeah.
yeah.
Okay. So
Yes.
that tells us that, right? So here's the no lapse period. We got some more definitions. Here's an example of some of the charges. We got an index monthly account charge, which is the deduct from each index account on a monthly policy date up to the insured's age 121. So they're going to take this out every month. Some more definitions. A policy loan is charged at 3%, right, with a maximum preferred rate of 2.25%. I don't know the reason. I know what this is because we called the company. If she takes a loan, she has till November to pay the loan back at 2.25%. And if she doesn't pay it back by November, then it's 3%
Gotcha.
for her own money that she already put in more than she has. She gets to borrow her money at 2.25% if she pays it back by November. And if not, it's 3%.
It,
You
Um,
mean
it,
1 month?
it says right there, Matt, that the preferred rate of 2.25% is available after the 10th policy year.
okay,
Oh,
so that's not, she can't get that either then.
yeah.
That's not what they told us on the phone, but that's okay. So now we got some more definitions, more definitions, more definitions. Another policy fee is an expense charge that will be deducted from the policy value each month. A premium expense charge is a premium of a percentage of each premium payment deducted from the paid premium prior to allocate to the index options. I'm sorry, account options. So there's some more charges. So now we're done with the still more definitions. My bad. I thought we were done with definitions. Here's some more definitions. Here's a couple more definitions. And this is huge right here. Non-guaranteed values and benefits showed under this heading are based on non-guaranteed rates and charges. The non-guaranteed values assume that the currently illustrated non-guaranteed elements will continue unchanged for all years shown. Since this is not likely to occur, actual results may be more less favorable than those shown. Non-guaranteed elements are subject to change by the company. Additional premium payments may be required to keep the policy in force or to achieve desired results. Let me ask you
That's
a
what
question.
makes me upset with these people because they put it in writing.
Yeah,
So they
yeah,
automatically think that the
right. This
consumer
is the ultimate CYA, right? This is the ultimate. So now check this out. So
ultimate.
this is the part that makes me mad. Okay. So I'm gonna go to this here real quick, and I'm gonna show you what this is. I don't go through the whole policy of people. Okay, so here's her policy again. This guy Chester Pallid sold this, and what typically happens is that insurance agents sell this as an investment, right? That's what we usually run into is people have an insurance license, they sell this as an investment. They might even think that they're doing the right thing because that's what they were learned or taught, and that's what they did, and but check this out. This guy actually has an investment license. So he could have sold her an investment if he wanted to, but he chose not to sell the insurance policy because the way commission works, let me find my
He
hand.
gets paid more.
Yeah, way more. Okay, so she's paying $275 a month times 12 months. Let's say he gets paid, we pay the brokers 110% here, right? So he would have made $36.30 selling this policy. For her $160,000 life insurance policy that she didn't need, it would have cost, take a guess how much 160,000 would have cost with us.
Probably like $30 at the most.
$36, exactly right. Times 12 times 110% means that we would have made 457 by doing the right thing.
And she doesn't even need that part.
Exactly right. She doesn't need that. So he is registered. He could have sold an investment, but chose not to. And he has two disclosures on his record. One of them for 165,000 and one for 51,000. This one got denied, but it still says that the product was misrepresented, and this one was negligent while discussing certain features of the product he purchased. But here's the thing about it is this one's going to get denied too, and the reason is because of this right here. Because it's on the page. We don't have to do what we say we're going to do. We could do anything that we want to do. We can credit you what we want to. What you're going to get is the guaranteed and non-guaranteed, right? So then we have this. You said they cherry picked a year, right? They cherry picked this year to show that their 8.52 is better than 8.22. But I'll do this with you because I don't want you guys to think that I'm crazy. Let's do this quick exercise together, okay?
Can you show them the chart of the cash values?
Yep, I'm going to do that. But let's just do something real quick. This is interesting, right? So we got 4.69 plus 11.65 plus 3.65 minus 38.49 plus 23.45 plus 12.78 plus 1.54 plus 11.68 plus 29.6 plus 11.39 minus 0.73 plus 10.46 plus 19.4 minus 7.01 plus 28.88 plus 16.26 plus 26.89 minus 19.77 plus 24.02 plus 24.01 equals 194.35, right? Divided by 20 is 9.7175. And they put on the page that it's 8.22. You see that?
Yeah.
Mm-hmm.
That's crazy to me. They got this to show you that this is better, so they cherry pick a period of time to show you a number that's not even a real number. This is not what this equals. Is that crazy to anybody else?
Yeah.
That's wild.
Yeah.
Okay, so there's a page.
So they automatically lied.
Just straight up lie. So here's another.
They're pro.
But who's going to read the policy and who's going to take the time
Do
to
that.
add these
Nobody's
numbers
going to do that. Mhm.
Who's going to do what I just did? Who's going to actually?
I'm surprised you did it.
Yeah, I did it because I did it the first time, and then I told somebody I did it. I'm like, I got to prove that this is the truth. Let me see if I'm crazy, right? So I did it 4 or 5 times. Okay, there we go. Now here goes the numbers. Okay, guaranteed is guaranteed, right? This is what you get. This is what you're going to get no matter what. You can have this for sure. We have to give you this. Everything else on here don't matter. Here's what you're going to get for sure no matter what. That's what this says. Are we all on am I right about that?
Mm-hmm.
Okay.
Yeah.
So guaranteed, she's put in $19,800 so far. She started this with $6,000. She put in $6,000 and then she paid $275 a month for the last 5 years, basically. Okay, so she's paid $19,800 and right now she can take out $14,874. And Remember, she has a $160,000 life insurance policy that she doesn't need, and the death benefit now is worth 278. So the insurance that she doesn't need doubled, and the investment that she did want went down by 20%. Right? So if she keeps doing this until she's 67, because this is an investment and she wants to retire, she'll put in $100,000 and she'll get 47,000 back, and her insurance will double. Okay, is this what she asked for? I want a blue.
No,
I want a blue car. Here's a red one. It's okay. The red one's better, right? No,
that's
here we go. So this is guaranteed, and it's guaranteed because remember the insurance goes up every year, and that's on the last page. We'll look at that, but it's annually renewable term, and she's not paying the 1303 no lapse premium, so her policy on paper guaranteed to be zero by the time she's 83 if she pays in $150,000.
And that's if she
yeah.
never uses anything.
Exactly.
You
Nope.
know, because again, people purchase these because they can be their own bank, right? So
Mhm.
if they can take it out to buy a car or take it out to use for a down payment for a home, it would lapse a lot sooner because the cash value would not be there in order to sustain it when the policy premiums are more than what
Increase.
she's paying.
Mhm.
Right.
Mhm.
So, I mean, if that's the case, if people actually use them for what they're trying, what people tell them they can use them for, then their policies will lapse a lot sooner.
Because they took
Can
out the
we can we do something real quick, Matt? So you see at 65, the cash value, what's the cash value at 65?
46,810.
40, okay, gotcha. So can we do a quick compound interest calculation?
I'm
Like you
gonna
said,
I'm gonna do that. I already have that. Well, I'll show you
you
that.
have it. Okay. How much would she have had if she had gotten the term for $36?
I'll show you in one
And
second.
then invest the difference at 65, how much does that end up being?
I'll show you that. I have that in a second, but first I want to run through this. Is that okay?
We have kind of limited time, so I don't know.
It'll be this is so non-guaranteed by age 67, she'll have 114,000. This is the first non-guaranteed page, okay?
Mhm.
She'll have 100, she'll put in 100, she'll have 114, her death benefit is more. That's the first non-guaranteed that also gets to zero by age 93. Now there's a second non-guaranteed page because the first maybe you can have this isn't enough, so they got to show you this again. And this one is 67 to have 215. Okay, so this is best case scenario. Please see the values under the guarantee projections in big letters on the page of the fake numbers that they don't have to give you. And this one goes to 121 because we all know people that live to be 121, right?
Oh yeah.
I mean, all my whole family always lives to 121. That's what we're gonna do. So check this out. So now what's gonna happen is we go if I would have met with her, we would have given her a real investment into actual mutual funds over the same time period of where she started. She would have put more in because without the fees, this is how much she should have had in, and it would have grown to 31,000. So this is a real actual investment with an Chester could have given her this if he wanted to, right? But he didn't. He decided to take the commission. He decided to get $5,000 and take the $5,000 from her, and now she could have had 31, and this would have did 13% in that time. So check this out. If she did 7%, if she got 7% in the market, her policy would have been 26,000 right now. She would have had some increase, and at age 67, Hector, to your point, she would have $259,000 at 7%. And what's the market averaged over the last 100 years? Thanks for
10%.
asking. The S&P has averaged 10.463 over the last 100 years. This is the article as of June. Okay. And if you want to think longer, it's done 9.3 shorter. So we're going to say the market over the last 150 years has done between 9 and 15 on average. Fair? Right?
Mhm.
So if she gets 10, because that's what the S&P has averaged over 100 years, she would have $418,000. And if she gets 13, like the portfolio that we had did, she would have $695,000. So even if she gets a 7, she gets better than their second non-guaranteed page of maybe if you're in a dream world, this is what you'll get.
Mhm.
Even if she just gets 7, she still gets better than the dream world. This stuff is crazy. And we need to be comfortable talking to people about it. We need to be comfortable and showing people and be confident to get these policies to then show the people that what they're buying isn't what they say. Because if I didn't get your policy, Jennifer, would you have believed anything that I said? If I didn't highlight this in your policy and show you what your policy said, if I just said, Jennifer, this is what I think we'll do, you would have never believed me.
No, because remember when we first talked, I was a big proponent of it.
That's why we started the conversation.
Yeah.
Jennifer had an IUL, and Jennifer canceled on me 2 different times, but I still wanted to meet with her to show her the IUL. And we ended up meeting like on a Sunday afternoon or something.
Mm-hmm.
Like on a weird time. She's like, this guy really wants to meet with me. And it's because I wanted to help her. I hate these people having IULs. I can't stand people having an IUL. I think it's horrible. It's not okay.
By the way, if you calculate your FIN number, right? Because we sell it as an investment, right? That projection is like is that enough to retire 215,000? Not even
No.
close. Yeah.
No.
Like
They also tell you, like, I think I didn't fully understand it either, that like you could spin down your policy and live off of it. And I was thinking that meant the death penalty, but I think or benefit, but I think that just meant the cash value. So the whole time I was thinking, oh, I'll have like 500,000. That's why I got the increasing death benefit to live off of. But that isn't even right because I clearly didn't understand it correctly. And yeah.
And they let you not understand it. And then they hired you to pass on the
She got her license.
Yeah. I
let
had
that happen.
friends that I gave the policy to, not many. Luckily, I wasn't very successful. So that was good.
Yeah. I mean, that's the thing too about the agents out there that are selling this often don't understand it themselves.
They don't understand.
And they're just selling the hype. They're all excited about it because they themselves don't have a grasp of which numbers they're talking about. Yeah. And it's just a scary, scenario of like misinformation passed on as something fantastic. When you break it down, it's like an evil product, and the agents have no idea what they're setting up their clients to have. Yeah.
So, awesome, guys. We got 4 minutes to 10. There's a really awesome training that was recorded back in 2023 that kind of goes into some of this stuff in more detail. I'm going to post that to our John Lavin and Connor, I think.
It's called like IUL Kill.
There's a couple
on the LFIC day.
Yeah, it's the guy is like one of his RVPs.
I don't know. I only
that breaks it down. But anyways, last name is John. I forgot Connor. Not the term.
Share it. Yeah, please definitely share it in the group chat. That'd be great.
Yeah. And okay, awesome. So we're halfway through the month, guys. I think we can definitely do a follow up on this training and kind of into some more of the details.
I feel like the next training can be on like the farce of living benefits and like what that whole part of it, because that's a whole other
open it up for questions to see if anyone maybe has some questions. You don't want people to leave confused about.
Yes. Something. Does anybody have any questions on any of the stuff we went over today?
Yeah, Sean,
I didn't cover everything, but
yeah, Sean, I think the explanation for the dividends in an insurance policy compared to dividends from a stock or portfolio, I think it was spot on. Because if you don't understand it, you sit with a client, they're gonna think everything you're saying is a lie because they see the dividends right there. So I think that was great to bring that up.
Yeah, and it's important to note also that the dividends in the IUL are not actually going towards their cash account either. They're actually using it to purchase additional insurance. And that's why the death benefit is going up. The death benefit is going up because the dividends are being used to purchase additional insurance versus being used to actually put towards the cash value.
So the overpayment that you're paying,
the overpayment that you made, the company is still not giving it back to you. They're using it to purchase you more insurance.
More insurance.
So they're still keeping your dividends regardless of how you look at it, right? Because when you have dividends and investments, you have an option. You have an option to reinvest those dividends and the investment that you're investing with, or you could actually take them if you wanted to. In this case, they're using them in order to purchase you more insurance. And I know we're going to go over it later, but the reason why is because life insurance policies were never intended to be used as investments. So
That's
they
right.
have to follow certain rules to make sure
Right.
that there's a balance between how much cash value you have in your account and how much your death benefit is. Because if
That's
they
right.
don't, it'll flag the IRS and they'll say that you're trying to use your life insurance as a tax shelter.
There's a
That's
And
whole
right.
page
your
on that.
life insurance license, you remember this, right? Because there's a whole part about that in life insurance class that teaches you that life insurances were never meant to be used as tax shelters. They
Mm-hmm.
were meant to, create an immediate estate in the loss of a breadwinner is what life insurance policies were meant to do. So if you do too much, okay, you know how you're doing too much, right? If you do too much, you put in too much, it flags and says, hey, somebody is doing something tricky with their life insurance. So the way they try to prevent that is they use the dividends to keep you purchasing more so that the cash value is not alarming and it doesn't trigger anything to say that something is not right. Okay.
Mm-hmm.
Because when that happens, you're going to lose all of your tax benefits that they tell you that you get tax free.
Look how crazy this is, Shonda, based on what you just said. In this here, it says there's a whole page on to ensure compliance with federal income tax law. Transamerica Life Insurance Company will monitor the level of death benefit and premiums and reserves the right to adjust the death benefit and limit or refund any amount of premiums to preserve the qualification of the policy as a life insurance contract.
Mm-hmm.
So they'll make sure that it's right so that they don't get sued.
That's
And
right.
do it if they
That's
want
what
to.
the properly structuring is all about.
Yep,
So when
exactly.
you hear them talking about you have to make sure it's properly structured, it
Mhm.
has to be a certain way because if it's not, what'll happen is that the IRS will now take away all of those
Mm-hmm.
tax-free options
Yeah.
that they market so much, right? So, it's all to preserve the life insurance company. It's all to protect the life insurance company. It's not about the client actually being able to invest their money and seeing great returns on their money. It's all about the insurance company making money. So, I mean, I think that, that's a huge thing. And, when people are like, because, one of the things they will say is people say that you don't get a benefit that they're taking your money, but look, your death benefit is increasing, right? Because so you are.
Mm-hmm.
We're not taking it. If you add this up, it shows the increase in your death benefit.
Mm-hmm.
But I didn't buy this for the death benefit. You know
Right.
what I mean? That's not what I want. So I think that it's just important to note that that's what the dividends are used for. They're not added to the account, the cash
And
account.
even if you did buy it for the death benefit, you bought it for the amount of death benefit that you purchased early on, not for it now to go up and you don't have any savings.
Yeah, it's a very expensive death benefit.
Yeah, very expensive death benefit.
I can't believe that people are okay with selling it.
Oh, okay, because they make more
Again, a lot of
money.
people don't understand it.
Yeah, they make more money and they don't know what they're selling, Matt.
There's actually a lot of like the higher ups, like when we would go to the meetings and do these things, trainings, a lot of them had security licenses and then weren't using them anymore and only doing the IULs
That's
too.
right.
Yeah, and it's because of how much they get paid. So for like someone if I open up, a mutual fund account for somebody for the 255 that you were paying for that IUL,
Yep.
the amount of money that I would get paid to do that, and I do it, for families all the time, but it's
Correct.
minimum,
Yeah.
$8.
if you're in an investment business on your own and you don't have all the like by having all the products, we're able to, make a
Correct.
very good income because we have multiple areas. But if you're just doing an investments, usually
Yep.
an investment person is just trying to find somebody that has, 2 million. They're not
Correct.
trying to help you accumulate wealth. They're not going to open up a $250 a month mutual fund for you.
That's right.
Right. So they're ignoring middle America, because they can't make money doing that. That's why they're all doing IUL. It's not because it's the right thing to do. It's because it puts
Money.
money in their pocket.
Yeah.
And that also goes to show you that you can give people the benefit of the doubt and say many of them do not understand. But
They
I
do.
dare say
They
that if
do.
someone is investments licensed, they
They
do
understand.
Yeah, those
All right,
upper those
so
guys
those
understand.
people know
Yeah,
that you could get far better returns by investing your money in the market, and they're making a choice
yeah,
to sell these products because it earns them more money. Now,
And you
some
can
of
bet
the
their
newer
money's in the
people
I
market.
was
that
just
just
going to say
got
that, Denise.
just got life licensed and stuff, they probably don't know. They only
right.
know what the company has told them. They
Told them.
don't know, right? But those people who have investments license, oh, they know.
And
Yeah.
they know that's where their money's at.
Oh, they know.
Yeah, and they're too far in. They're too deep to do the right thing. For them to say, like, once they realize, oh my God, this is wrong, they've got all these clients they made, they got money, they have residuals coming in, they're just like, oh, for them to admit it, they would have to stop doing that. And that would, they'd start over. They're not going to do it.
It's either that or either they're money hungry and they've gone into it already with their investment licenses and they know.
Yeah.
That's true. That's true too.
Mm.
That's true too.
And the ones that had their investments licenses, a lot of times, generally speaking, typically have some sort of infraction for not doing something right or
Mhm.
misrepresenting something when it came to an investment.
That's
And
right.
then so they switch over to the insurance side. So then they don't have to worry about the
Client.
infractions and
That's right.
compliance on the investment side, right? So I mean, again, it's selfishness. It's not about fiduciary responsibility. It's not about what's best for the client. It's about what's best for the person that is selling the product to the client. And so, you just want to make sure everything that we do is all about doing the right thing for people.
Mhm.
And it's about, making sure that they are getting what they need
That's
and
right.
not we're filling our own pockets, okay?
That's
Because
right.
we want to get paid for doing the right thing, for people. So, you just want to just kind of take a look at these things and, ask your clients questions. You will oftentimes, just by asking questions, what you'll find is that the reason why they purchase the policy is not aligned, the policy is not reaching the goal that they
Correct.
actually purchased the policy for.
That's very well said, Shonda, for sure.
Yeah.
Mm.
That being said, you can still make a
All right, guys.
All right, have a great weekend.
Take care, guys.
Great, great,
Have a good
great
weekend.
job, guys. Thank you.
Thank you.
Bye, y'all.
Your policies.
Yeah, let's go find an
It'll help.
IUL.
Haha.
Well, one